Hello, my dear students, and welcome back. I know your exams are just around the corner, and a lot of you have told me that this chapter, financial management, feels a little scary. You see all these big numbers and complicated words, but trust me, by the end of this session, you'll realize it's actually one of the simplest chapters. So come on, let's dive right in.
You know, when we're scrolling through the news, we always see these headlines, right? A company is raising thousands of crores of rupees. Another company is buying someone for a mind-boggling amount. It can feel a little intimidating. And you must be wondering, how on earth do they manage all that money? How do they make these massive decisions?
For instance, you probably remember the news when Tata Steel bought that huge European company, Chorus. To make that deal happen, they had to arrange something like 36,500 crores of rupees. Wow, that is a number with a lot of zeros. Well, today, we're going to understand exactly how companies pull off these huge financial moves.
Okay, so what is this financial management anyway? Don't let the big name scare you. At its heart, it's nothing but managing a company's paisa. It's really about just two things. First, figuring out where to get the money from. We call that procurement. And second, deciding where to use that money. We call that usage. The whole game is just doing this smartly to get the best possible results. Simple, right?
Now, all this planning, all this smart work, all these decisions, they are all done for one single primary objective. And what is that main goal, you ask?
Here it is. The number one goal is to maximize the wealth of the shareholders. And who are the shareholders? Well, they are the real owners of the company. So, a financial manager's main job is to make decisions that increase the market price of the company's shares. You see, when the share price goes up, the owner's wealth goes up. That's it. Every single decision is judged by asking one simple question. Will this make our shareholders richer?
Okay, so the goal is clear. Make the shareholders happy. Make them rich. But how? How do you actually do that? Is there some kind of secret formula or a map to follow? Well, guess what? There is, and it's actually very, very simple.
The entire secret is in making three key decisions correctly. I like to call them the three golden decisions. First, the investment decision, which asks, where should we put our money? Second is the financing decision. Where is this money going to come from? And third, the dividend decision. What do we do with the profits we've earned? If you can master these three, believe me, you've mastered this chapter. Let's break them down one by one.
So, first up, we have the investment decision. This one is all about deciding where the company should invest its funds to get the best possible returns. Think about it like this. Let's say you have some money. Should you buy a powerful new computer that will help you learn and maybe even earn for years to come? Or should you just spend it on daily stuff? One is a long-term investment. The other is just a short-term expense.
Now, these big, long-term decisions, like, say, building a brand new factory or launching a completely new product line, they have a special name. It's called the capital budgeting decision. Make sure you remember this term for your exams. These decisions are absolutely crucial because they involve huge amounts of money and, they're often irreversible. You can't just undo a factory once it's built. A wrong move here could really hurt the company for years.
Okay, let's move on to the second golden decision, the financing decision. So the company has decided, let's build a new factory. Great, but where's the money going to come from? Think of it this way. Do you ask your parents for money or do you take a loan from a friend? If you get money from your parents, it's kind of like equity. There's no hard deadline to pay it back, but yeah, they might have a say in your life. But if you take a loan from a friend, that's like debt. You have to pay it back with interest by a certain date. No excuses.
So this is the main choice every company faces. Debt or borrowed money is usually cheaper, but it's risky. You are legally obligated to pay it back with interest, come what may. If you can't, the company could actually go bankrupt. On the other hand, equity, or the owner's own funds, is much safer because there's no compulsion to pay anything back. But it's costlier in a way because you have to share your ownership and all your future profits. A good financial manager is someone who finds a really smart mix of both.
Now, let me tell you about a little secret trick. It's going to sound a bit strange, but can taking a loan, taking on more debt, actually make the shareholders, the owners, richer? Your first thought might be, no way, loans are a burden. But the answer is, sometimes, yes. Let's see how this magic actually works.
I want you to look very carefully at this table. It's straight from your textbook. So we have three situations here. In the first column, with zero debt, the earning per share, or EPS, that's the number at the very bottom, the most important one, is 93 pice. Got it? Okay, now look at the middle column. The company takes a 10 lakh rupee loan, and what happens to the EPS? Whoa! It actually goes up to 1 rupee and 5 pice. Now for the last column, a 20 lakh loan. And look at the EPS. It jumps even higher to 1 rupee and 40 pice. The shareholders are literally earning more money per share even as the company takes on more debt. How is that even possible?
Well, this magic only happens if one very, very important condition is met. The company's return on investment, or ROI, has to be greater than the interest it pays on the loan. So in our example, the company is earning a 13.33% return on its investments, but it's only paying 10% interest on the borrowed money. That extra 3.33%, that's extra profit that goes straight into the pockets of the shareholders. This is the key. But just imagine if the return fell below 10%. Then this magic trick becomes a nightmare and can destroy shareholder wealth.
This clever trick, this idea of using cheaper debt to boost the earnings of shareholders, it has a special name. It's called trading on equity. This is a very, very important concept for your exams, my students. So please remember this simple definition. And that brings us to our third and final golden decision, the dividend decision. So the company has worked hard, it's made a profit. Great. Now what? The question is, how much of this profit should be given to the shareholders as a dividend? And how much should be kept inside the company for future growth? It's just like when you get pocket money. How much do you spend right away, and how much do you save in your piggy bank for something bigger you want to buy later?
Now, this is not an easy decision. It depends on a lot of things. Like, for example, how much profit do we actually make? Obviously, you can only share what you've earned. But then, does the company have exciting growth plans for the future? If it does, it might be smarter to keep that profit and reinvest it to earn even more later on. The company also has to check if it has enough actual cash in the bank to pay out. And of course, you have to think about what the shareholders, the owners, really want. It's a tricky balancing act.
All right, and that's pretty much it. We've covered the entire core of this chapter. So now, let's get to your exam super mantra. Let's do a quick revision of what you need to remember to get full marks in your exams.
I just want you to remember this simple framework. What is the one primary goal of financial management? That's right, to maximize shareholder wealth. And how do we do it? Through the 3 golden decisions: the investment decision, the financing decision, and the dividend decision. If you just remember this much, you can answer almost any question from this chapter, I promise.
So for example, if you get a question just like this in your board exam for 5 marks, what are you going to do? It's so simple. First, you will write about the investment decision, and you can mention capital budgeting. Then you'll explain the financing decision, talking about debt and equity. And finally, you'll explain the dividend decision. Just write a few lines on each, maybe give a small example, and you will easily score full marks. See? I told you it was simple, didn't I? Financial management is just a logical way to think about a company's money, so please don't be afraid of it anymore. You have understood the core concepts so beautifully today. You have absolutely got this. Now just go and ace those exams. I have full faith in all of you.
And I'll just leave you with one last thought to ponder. The next time you're reading the news and you see that some big company has taken a huge loan of thousands of crores, you are now smart enough to ask the most important question of all. Is their return on investment going to be higher than the interest they are paying on that loan? Think about it. All the very best.